National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
On today's show, life insurance proposals and illustrations with industry consultant Bobby Samuelson.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. I am your host, Steve Savant, and we're broadcasting live to a nationwide network of financial advisors. And today with me, and I have to say, broadcasting out of Fountain Hills, he came all the way from North Carolina, Bobby Samuelson, industry consultant. Welcome to the show.
Thanks for having me.
If you missed Bobby's other show, I have to tell you, I love controversy and I love to be disclosing. That was a disclosure, disclaimer, caveat show par excellence, right? We had a lot of fun. Today, people will be crying after the show, I'm telling you. After this show, people will be crying. We're going to talk about proposals and illustrations. I have an article coming out called Vapor on Paper. We are going to, I'm so sorry, we're going to have to do a little expose today.
Yep.
And it's going to be brutal for some agents who have been, in my view, propagating the absolute best la-la land scenario, right? I mean, really, think about it. And we're going to be talking about how maybe we think you should. Bobby and I, we live in this arena. I've been in this thing 30 years. I mean, just trying to figure out illustrations and proposals. And we become so good at it, we can make these illustrations dance and sing.
Yep.
I mean, we are good at it. But I want to be more of a reality quoter. I don't want to be sitting in there in fantasy land.
Yep.
So Bobby, let's get down to it. Let's talk about indexing because it's so popular. Let's go to there first. I'm looking at a 30-year look back. And it's because these guys are playing in foreign indices. And those foreign indices knock down 9+. The three carriers that are showing this, which will remain nameless,
Yep.
those three carriers are giving a look back at 9+. No person that's quoting their own illustrations is doing less because they were able to validate in their mind 9+ rate of return.
Yep.
So I have a 9% index for these three carriers, and everybody I know that's quoting these guys is hitting that number.
Yeah, so that's a big issue. There are a lot of different ways to approach this. I guess I'd start a little simpler, which is, just on the S&P 500 products with annual point to point, you can still get 7 to 8% illustrated rate. And the big issue is the methodology that the carriers have prescribed. Is that the best way to do it? So. In your example, is it right to look back 30 years on these indices and use that for future projections? So the carriers you're talking about, one of the indices they use is the Hang Seng.
Oh yeah.
Yeah, and so you say...
And remember, a couple years back, they were huge. Their returns were a monster.
Yeah, exactly. So you look at it and go, okay, well, is the last 30 years indicative of the future 30 years? And not only that, but could you have actually built this indexed UL product 30 years ago? Because remember, IUL products have only been around for 1997 was the first one. They went into a lull, and the products you're talking about have been around since 2006. So there's no real history on how these products actually perform. And could you have even built them 30 or 25 years ago? And that's a big, broad question. So there's a lot of issues with this whole idea that you can just take historical data, put your current cap and participation rate on it, and apply it backwards and getting a meaningful future projection. And actually, it's funny, if you look at some of the disclosures on the illustrations for the carriers you're talking about, there's a big, bold paragraph below that says, these results are in no way indicative of future performance. They should not be used as any indication of future performance. Basically, our data was bad, there was overlapping confidence, all sorts of things basically say, do not use this data to project future returns, but what are agents doing?
They're using it. Not only that, but I have to complain here, I'm so sorry. There are several illustrations that actually show the last 30 years of S&P, the actual returns, negative and positive, through the 30 years, and then they stick that paragraph of disclaimer on at the bottom.
Yeah.
And I'm thinking, if I'm a client and I know nothing, and the odds are 98% of our clients don't know this,
That's right.
They're looking at that S&P and saying, wow, that doesn't look bad. Look at the numbers, look at the history. And we weren't even invented we weren't even born.
Yeah.
I mean, you weren't born, Bob.
Well, you were.
I was there, but But I was there. I was there when Sir Edmund Halley invented actuarial science in 1782 in England. Yeah, I'm sure. But that's what I'm saying. We're looking at that. You see what I'm saying? I'm struggling with then the carriers put this big caveat on underneath a historical S&P, not anything else but S&P, and they show all those numbers, and we just go, oh, Well, that looks like a good story.
Yeah, that must. And so the big thing I say, so well, what are you showing for a VUL contract? Because if you're gonna show 8% on IUL, what are you showing on VUL? And there are two kind of key things to think about here. Number one, IUL is not a risky product. So the first thing you ought to think about with IUL is that in fact it is not risky, and the reason is because it has a 0% floor. And the definition of risk is the opportunity for downside.
All right, so can I just say this just as a plug for IUL? If that's true, then can I say that the Morningstar beta risk, right? And if you're doing the S&P, the VIX would be 0. Maybe I couldn't say that, or
not quite that, but it's close. Okay. I mean, the idea would be basically what is the beta for indexed UL? Because what the lookbacks do is they don't tell you what the beta is; they just show you the returns.
Right.
They don't show you the beta on it. So what I'm arguing is that in fact this is a low risk product. And if you believe that risk means return, so you take more risk and you get more return.
Well, I think clients believe that risk means loss of principal.
Yeah, potential loss of principal.
I think that's their definition.
Exactly. So if that's the way they think about it, then IUL doesn't have any risk in it because there's no loss of principal, and it still gives you upside potential. So the main issue is, if
I just want to say, just so that we cover our back, it's no loss of principal on the crediting rate. We still have bills to pay. The COIs come off in a 0 year.
Yep.
So to say that I'll never lose principal, I don't know about that.
Right, that's right. But compared to, if you're going to be in the life insurance chassis, you're always going to have policy charges. Right. So basically, we have two issues here, which is.
So there's no such thing as a no load contract.
Not right now.
Okay, all right.
That may be coming.
I just wanted to throw that in.
Yeah. So basically, what we have here is we say, okay, well, Mr. Agent, you're showing IUL at 8%, and you're showing VUL at some other number, and IUL is less risky than stocks, okay, because it has no downside.
And the expense loads comparatively?
Let's just say they're equal.
They're equal. Okay.
So let's just say they're equal. So there's no risk in an IUL product basically. And on top of that, there are dividends in stocks, but no dividends in IUL. So if you're showing VUL at 8%, and that's dividends, which let's say that's at least 2% of your return, then equities without dividends is 6%. And if you believe that more risk means more return, and IUL is not risky, then you should be showing it at a rate lower than equities without dividends, right? So the issue would be, if you're showing VUL at 8%, you can't show IUL at 8%. Because in every sort of framework, that number is way too high because, again, equities are riskier and they include dividends. IUL, no risk, no dividends. So the problem is the carriers have given producers a construct and said, well, if you just apply this to historical data, you're fine. But if these same advisors are selling equity returns going forward, unless they make the same assumptions about the past, take those same assumptions and apply them going forward, those IUL rates are completely meaningless. So in order to hit 8% in an IUL product, you might have to do 12% in equities and 7% in bonds. Are you comfortable making that assumption with other assets in the client's portfolio? And if your answer is no, then you can't use historical index data.
Well, let's stop there before you go there. I'm still back at the door at, if you're showing 8, I need 12 on an index to make that legit. Is that what you just said?
Well, yeah, and the math is a little bit more funny than that, but more interesting than that. But basically, I mean, the idea is yes, those two things are. We can get into this if we have time, but those two things are mathematically equivalent. So everyone says, oh, well, IUL at 8% is like VUL at 12% in the 90s, right? Same. Well, actually, mathematically, yes, those are identical. You need the same. And historical returns for equities, let's say, are 12%, and bonds are about 7%. So if you're showing 7.5% on IUL, looking back over the same data where bonds were at 7 and equities were at 12, then unless you're willing to make a 7% bond, 12% equity return assumption going forward, your IUL rate at 7.5% is miscalibrated. So you've got to calibrate that 7.5% based on the assumptions you're making about right now about future equity returns and future bond returns. And the carriers are not telling that story. All they're doing is saying, just take the historical data and apply it forward without asking the question, are clients actually willing to assume the same thing that happened in the past?
Well, we are doing the pay it forward mentality. We are. Now question though, if I'm showing 8%, and I'm still back at the 8%, think about that, I'm drowning under the thought. If I have an 8% and I'm illustrating that, and you're saying, but the actual number I have to hit to actually credit 8 would actually have to be way in excess of that number.
Well, keep in mind, you're talking about long-term returns here. So we're talking about 40, 30 years of performance. So in any given year, you could hit 12 in an IUL product, no question.
Sure.
But remember, in the look-back period you're using to determine that 8%, equities did 12. So unless equities do 12 again in the future, and basically the same way they did it in the past, you're not going to be able to get your 8%.
Well, I noticed at the close of 2011 that the Ibbotson people reported that bonds in the 30-year outstripped, not by a lot, but it did.
But it did, right.
But it did. And I'm thinking, wow, would that paradigm, would that be a forward-thinking paradigm that bonds another 30 years are going to hit stocks again? And if it was, then all of a sudden I'm thinking, am I back to current assumption UL?
Absolutely, and that's a huge question, and that's again, the carriers have offered no guidance on that, or even told producers that they should be thinking that way, because the question you just asked is exactly the right question, which is, over the long term, are equities going to outperform bonds? And it's really not important whether you and I have the right answer. It's making sure that the IUL product and the illustration that you show, again, is calibrated based on the assumptions you're making for the rest of the client's portfolio. So if they say, hey, I don't think bonds are going to do much worse than stocks, I think they're going to be about even, then you shouldn't be showing IUL at a higher rate than bonds,
right? Because
there's no spread there. So producers are just taking the 7% and selling it without thinking twice about, hey, does this fit into the client's portfolio? Does this really work with the other assumptions they're making, with the other assumptions I'm making? And not only that, what kind of liability do I have if I'm wrong? Right? Because the historical numbers only apply if history repeats itself.
I'm telling you, you're giving the preamble for a return to current assumption UL, waiting for any interest rate movement upward, because we're so flat now. I mean, really, you're setting the stage for, I think, a complete redux of current assumption UL.
I think you're right, and I think I would actually go a little step further, which is, what's the difference between indexed UL and current assumption UL? What's the difference? I mean,
no, I'm the host.
Yeah, right.
I'm the host. I'm asking the question.
So, all right, I'll answer it.
Thank you, Mr. Rhetorical.
So what's the difference? Well, they're both general account products. They both put the vast majority of their money into the general account assets to earn a yield. The only difference is, in a current assumption product, they take that earning and credit to you every year, and in an IUL product, they take that earning and go buy your upside with it. So, in fact, indexed UL products are functionally identical to current assumption ULs. There's no material difference between the two. The only difference is, instead of crediting you the money in your policy, on an IUL, they just go and buy these options to give you the upside potential. So it's not even really a return to current assumption UL. I would argue that there's no difference between these two products. And anyone who says, I'm an IUL expert, is really missing the point, which is that if you're an IUL expert, you're really a current assumption expert too, because the products are functionally identical. They're no riskier to the carrier because they push all that risk. The IUL products are no riskier to the carrier. They look at profitability the same way for both product lines. And so what you're actually going to see, in my opinion, is in rising interest rates, a return to current assumption UL, because caps may stay constant, but interest rates may go up. So people may go, in my indexed account, why don't I put the money in the fixed bucket?
Why wouldn't they?
Well, they would do that if interest rates went up and the cap didn't go up too. Get it? So they wouldn't have as much opportunity upfront, but the fixed account bucket went up. So in the next segment, let's talk about why that cap might not go up.
Well, I didn't have to promote the second segment. My
There we
guest
go.
just did it for Okay. Well, listen, why are we doing this? Because we're talking about proposals and illustrations, and we want you to know how to do this in the best possible way for your client. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can write us at thebiz@brokersalliance.com, or even call us 1-800-290-7226, extension 147. After the break, Bobby and I will be right back as soon as we hear from our sponsor, Brokers Alliance, a leading distributor of life insurance and annuities in the country.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and in my own mind, interviewer extraordinaire. Hey, listen, before moving forward with anything we're talking about, at least we're not talking about derivatives like the last show, check in with your CPA, your tax attorney, and if you're FINRA licensed, your broker-dealer compliance department. If you want any quotes or questions on life insurance, DI, annuities, LTC, or group pension plans, just call us 1-800-290-7226, extension 147. Hey, it's not what I know, it's who I know, and that's why I have Bobby Samuelson on, life insurance industry consultant, and one of the bright young minds coming up. Hey, we're all looking for who's the next generation coming up? These are the young people that are coming up, brilliant guys and gals that really are just aficionados at such a young age. I can't believe what you know, Bobby, at your age. Wow.
Appreciate it.
Well, listen, it's just true. Before the break, you called the shot. You're the shot caller on the show now. Talk a little bit about what you want to. What are we talking? No, I forgot what we done.
So why is it you're kind of saying, hey, maybe you're ushering in the next realm of current assumption UL,
right?
Because if interest rates go up, maybe people want that product. So I think that's one of the things actually when we're talking about projections and illustrations that producers get wrong most often, which is they say if interest rates go up, you're going to want to be in an IUL product, and the reason for that is because they think interest rates go up, equities go up. IUL linked to equities, therefore, okay, well, first of all, the interest rate equity linkage is spurious at best. So that line of argument doesn't work to begin with. The second thing is, what happens when interest rates go up is a really complicated issue that includes all this derivatives exposure. So when you're illustrating these products to a client, and you're showing them 7 or 8%, and you're making the assumption that your product will improve, okay, so let's put it this way. You can either sell them current assumption of 5%, or IUL at 8%, and you're thinking that 300 basis point spread is going to be there forever, right? So you should always choose IUL because it's got 300 basis point better performance current assumption. But what happens if interest rates go up? And so what may happen, and this is why the carriers are very hesitant to talk about this, is current assumption rates will probably go up. It'll take a little while, but they'll come up. But the caps in the IUL products may not go up. And the reason for that is because as interest rates go up, carriers have more to spend on the IUL products per se, but the cost to hedge that actually goes up too. So what you find is potentially a linkage where the cap stays the same even though interest rates go up to 8%. So what that means is that the current advantage that we're looking at right now, or we're using all this historical data to get these artificial spreads over current assumption products, is a function of the current historical environment, not the future potential actual returns. And so basically the thing I'd really caution agents on is don't tell clients, hey, when interest rates go up, your cap's going to go up. That is absolutely...
It's actually counterintuitive.
It's actually very counterintuitive, but that is one of them. I mean, it could happen, but that's not the most likely scenario.
Yeah, that phrase you just used too, I could see that as a major league E&O issue. This artificial spread, this kind of, we're looking at this and saying that number, right? And it sounds great. And by the way, we haven't even got into arbitrage loans on that issue.
Yeah,
I'm just talking about the accumulation numbers, right?
Yeah.
Usually, people buy IUL for some kind of cash access and or retirement supplemental income.
Right.
Now, I sell it much more for income than anything else.
Right.
I don't know how to sell it for death benefit.
Right.
That's just me. But I'm looking at indexing, right? Strictly, now I'm talking about that 300 basis point spread over what we call an arbitrage loan, or the reason I don't like participation is because it always mixes it up with whole life and, but the arbitrage loans, the spread between the loan charge and the crediting rate. So all of a sudden we're making money on our own money, loaning to ourselves. I'm telling you, the first time I saw it, I was delirious.
Yeah.
But then I started saying, well, wait a minute, what happens if we have a down year?
Right.
But now I'm more concerned because of what you just said. That 300, we're all banking on it to be above the loan line. And
Yeah, it might not be.
I don't know about that.
Yeah, it really might not be. And not only that, again, I mean, there's no such thing as a perpetual money machine, which is basically what these loans you're talking about do, right?
Well, the United States government does that every day, so.
That's true. They've got a little bit more of a blank check than we do, though.
Well, these insurance companies got more money than whatever. Okay,
for now. So,
for now, yeah.
So yeah, I think that's a real concern because again, if you're showing, if variable loans may end up being, or whatever you call them, they may end up being the best option at the time the client actually makes that decision. But again, that's 20 or 30 years down the road. And the reason why they get sold is because the illustration happens right now. So I heard this, someone said this, and I thought it was great, which is the biggest crime in all of humanity is the Excel function that allows you to take a formula and drag it down like this without changing it at all. So what that means is that for a projection, all you have to do is put year 1, year 40, and just drag the formula down. You just extrapolate the data. And that's exactly what producers do when they sell those loans is they just say, hey, today we're going to show you 8%, we're going to show you a loan rate at 5%. Isn't this cool? You get $1 bazillion of income when the reality is the performance isn't going to be 8 in a 5% interest rate environment.
Right.
It's going to be 5.5 in a 5% interest rate environment. So your spread basically goes away. And then down the road, there's going to be actual performance versus the actual cost of the loan. And the client's going to make a decision, do I want to take a wash loan or a variable loan? And guess what? They're not going to look at the original as-issued illustration to make that decision. They're going to look at their in-force illustration to make that decision. So, and those are two totally different things. So again, I said this in the last section, but you're not selling performance with these contracts. You're selling policy charges, and you're selling the psychological benefits of a product that's rational when you're not, because it always gives you upside potential and always protects your downside. Future performance, who knows? So that's why I have a problem with participating loans, is it just sets today the future and pays no credence to the idea that it could be wildly different from what's shown right now. And there's very inadequate disclosure.
Well, there's very few carriers left that do zero net cost loans.
Yeah, 25 basis points, 50 basis points, whatever it is. Yeah.
And I'm thinking they may have after this show, they may have a little bit of a promo perk here.
Well, yeah, again, I'd say, look, your client's not going to make that decision about wash loans or variable loans until they actually take the withdrawals, which is 20 or 30 years from now. So you should not be selling an illustration just showing one type of loan, because the reality is in the future, they're going to make a decision that has, again, nothing to do with what you originally decided to illustrate.
Now, we've debated this thing too, and in regards to loans, I was always brought up withdraw at a basis after the 15th year to avoid the force-out rule, the Technical Corrections Act of TAMRA, the imposition of their laws over the first 15 years of a contract. So I withdraw at a basis to recapture it, cost me nothing to do it.
Yep.
But now everybody says no, because I can arbitrage my basis and make money on that, and I see that as the biggest mistake. Am I missing it?
No, you nailed it. I mean,
let's talk about it.
I mean, look, if the arbitrage, and you pointed this out actually at breakfast this morning, if the arbitrage goes the other way,
goes negative, right?
then you would really wish you had basis instead of pulling out a loan.
I guess you could punt and get it though. You could still go ahead and do withdrawals.
Yeah, totally. And that's the thing is, again, it's a decision you make down the road, not a decision you make right now.
Right.
And so it's interesting. Anyone who says, well, you shouldn't be illustrating withdrawals to well, that's a decision they're going to make 20 years from now. It's not a decision you're going to make right now. So why are we even debating this point? They have an option to withdraw to basis. They have an option to do fixed loans. They have an option to do variable loans. No one knows. But unless you show them all three options, you're not paying credence to the fact that future results are going to be completely different than what you originally illustrated. I mean, what's the joke in the industry, right? If you show someone an illustration, you know for sure that is the only thing that's not going to happen. Right? It never works the way it does in an illustration.
So far, my 30 years, no.
Exactly. So that's why this whole loan thing is so silly to me, because again, we're talking about numbers that happen 30 or 40 years from now. Client could be dead. Carrier could be not around at that point. Client probably will not even be in that contract, and it's part of the way they price these policies. And we're talking about what kind of loan option they're going to take. I mean, who's going to be even servicing that, right? And so, to me, it's just a completely irrelevant question, and it's amazing to me how much producers focus on that. It's just the wrong thing to think about.
Well, I totally buy what you're saying there, Bobby, as far as it's going to be so future. But I mean, we have to talk about it in some way, because the client's going to say,
"Show me
hey, how are you generating this income?"
Totally, show them the option. Say, "Hey, I got withdrawal to basis fixed loans, withdrawal to basis variable loans, then fixed loans and variable loans." There you go.
If you're out there and you're saying, "Steve, I'm proposing arbitrage loans all day long because the participation spread is so great, it makes the illustration look like unbelievable," but I promise you. And most withdrawals to basis spread over the life of, let's say, age 65 to age 100, it's all going to be somewhere around 5 to 6 years recapture. If you're going to go this way, and I'm not saying you should, but if you're going to go this way, you better park in your brain that withdrawals to basis is going to save you about 4 or 5 bad boy years that you're going to need to use it, because your policy loans, your arbitrage loans, are going to kill the contract.
Yeah, that's
so
right.
it's going to be it's kind of a in the bank. I'm going to keep it in reserve. The mechanics of this, remember, you don't have to do this. We do this all for you. We know the TAMRA code, the DEFRA institution, the switching options. We manage this to the ground. And by the way, the first carrier has finally come to the table on this issue that will auto-plate this in your contract. Blows my mind. I can't believe they're releasing this. This will be able to do auto loans, withdrawal loans. They'll make the choices for you based on the mechanics. The client will have to be notified if they change that, but I say let them be notified, full disclosure.
Sure.
If I have a carrier doing this, it takes the onus off me and takes the E&O off my table.
Yep.
This is the first carrier. Now, whether the industry will follow these carriers down this road, I don't know. But it's the first shot as trying to help us in the field. They're kind of leaving us alone here.
Yeah, they are. And administration's a big deal. I mean, when you talk to carriers about when they see underperforming contracts, more often than not, the contracts are underperforming because they're not being administered correctly. So anyone who's out here selling, again, all these complex structures, unless you're planning on sticking around and administering these things, whatever you showed is definitely not going to work just because you didn't administer it. So I see the march of technology being the carriers finally get into the modern age and do things like what you're talking about, because we have to have that as an industry, unless they're willing to pay levelized comp, which is a whole separate issue that could do a whole different show.
Anathema.
Just saying.
Wow. I remember we went through this in 2000. I don't want to go through that again.
Yeah.
I just want to encourage all of us here, when we're doing our due diligence, to just talk about the reality check. Do the gut check. You can still show it if you want to show the A, but tell them more than likely this is the number. I know that advertising and reality are two different things, and I get that. And we all have to make a living, but we have to do something to bring a little bit more, I would say, due diligence and due care to the way we illustrate, to the way we do proposals. It's only a form of advertising. Many times it has very little to do with the contract.
Yeah, and that's the point I'd really make, which is no matter what illustrated rate you show, the performance of the contract is going to be whatever it's going to be. So whether you sell it at 5% or 8%, that product's actually going to perform at some other number. And the question is, do you want to be a habitual over-promise, under-deliver guy, or under-promise, over-deliver guy? And if you're setting the bar at 8%, you've got a high hurdle rate to cover.
I want to be the first one. Hey, listen, you can watch this show and all our shows on our beautiful HD 1080p broadcasting right on our website, www.brokersalliance.com. When you come to the homepage, just click on the red On Demand section. And of course, all our links are all over Vimeo, YouTube, Facebook, LinkedIn, and Twitter, where I tweet. Yeah. Well, this is Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.